let's turn to CVS because that finished at the bottom of the S&P 500 today. Shares sinking after the company replaced CEO Karen Lynch with longtime executive David Joyner. CVS also issuing a warning that higher medical costs are pressuring earnings. You can see shares fell today 5%. Joining us now, Deutsche Bank Managing Director George Hill. George, it's great to have you on. What struck me about this announcement today, and I wonder how much of this actually added to the selling we saw, is the fact that apparently these leadership changes happened yesterday, but the company didn't actually disclose them till today. How does that speak to succession planning, transparency, and sort of the direction of this company?
Morgan and John, first, thanks for having me. This decision made yesterday and being announced this morning, I don't know is that unusual, just giving a morning disclosure is normal for a company the size of CVS. And CVS typically discloses events in the morning and not after the close. I do think the issue with the shakeup is really the way the board approached this. CVS is a company that's underperformed for a handful of years now. We've been very critical in writing of current management's execution. And this is a situation where we would have expected the board to be a little more transparent in the process, maybe naming an interim CEO, maybe doing an executive search around a new person who really had strong executional skills in the managed care space, which is where the business has been falling down, as opposed to just kind of hand-pointing an executive who's been with the company for more than 20 years. That's not to say that David is not the right guy for the job. We think there just should have been a more process-based approach to his selection as opposed to the board just picking somebody, especially given the underperformance of the company over the last several years.
So looking at this warning about higher medical costs pressuring earnings, what are attributed to the higher medical costs? I mean, this is still post-pandemic hangover and the fact that you have a lot of folks that are uninsured, for example, who are now seeking medical care. I mean, you have a lot of these different components that are being talked about, particularly in this election cycle. Is that showing up here in results as well?
It is, and it's showing up in the other managed care plans as well. And I have what I call a funny narrative I like to tell about this is, this is the post-COVID utilization increase. CVS and other managed care plans are particularly seeing it among seniors. They're particularly seeing it among supplemental benefits. You think about seniors, everybody's grandmother and people over the age of 65 or 70. They've essentially been locked up in their house for the last 3 or 4 years, and COVID is finally ending. The utilization is opening back up. I joke, Grandma wants to go on that cruise. She's getting her knee done. She's getting her hip done. And that's leading to the explosion in utilization that we're seeing amongst the MCOs that service the senior population, which is driving a rapid increase in medical costs that we just don't think that they've been prepared for and that they haven't anticipated. And CVS and the other managed care companies that are focused on the Medicare space have just seen this rapid increase in medical utilization that they haven't priced for and been prepared for.
And George, that's the part that, for the uninitiated, it probably doesn't make sense. Like if you had said to me a decade or so ago, oh, look at how the population is aging, do you think drugstores would be a good bet? I'd say absolutely, everybody. But we're in a situation, whether it's CVS, Walgreens, a slightly separate issue, where the more older people are utilizing health care, the worse it is for these companies. What kind of business model shift might fix that?
As it relates to the retail pharmacies, we don't know. And we see, and again, we have the advantage of kind of trafficking in this data every day and kind of being in the weeds on them every day. The problem with the retail pharmacies is, number one, there's too many retail pharmacies in this country. And number two, there's 3 payers that basically control the retail pharmacy channel. And pharmacies are forced into being a position of a price taker each year as it relates to how much they get paid for prescriptions. Quite simply, the people who pay for prescriptions want to pay undifferentiated pharmacies less money to fill those little orange bottles every year because there's just too many pharmacies out there. For what is the right business model on a go-forward basis, I think a lot of these companies are trying to figure that out. You've got the big managed care companies buying into provider organizations and trying to take risk. You've seen the retail pharmacies try to buy into the provider businesses and take risk. Historically, provider businesses, doctor-based businesses have not been great at taking risk. That's been more the business of the managed care companies, but they're trying to vertically integrate. And kind of from a top-down perspective, I think you hit on something that we're all very focused on. Healthcare in the United States is very expensive. Nobody wants to pay more for it. We're all trying to figure out how we get more value out of the healthcare dollar. And what happens in that environment is there's going to be a lot of businesses that get squeezed in that pursuit for value. You called out retail pharmacy, where CVS is the largest pharmacy chain in the country. They're going to be one of these companies that gets squeezed for value. But in every subsegment of the healthcare market, you're seeing this drive for value and this drive to get the most for your healthcare dollar. And a lot of the companies right now are just they're falling victim to that.